Hello, everyone, and welcome to our November investment market update. Today, I'm delighted to be joined by Mike Parsons, who is the head of distribution for Foresight Capital Management. Hi, Mike. How are you?
I'm very well, thanks, Mike. Yeah,
Good.
pleased to be joining you.
Good, fantastic. I think you did one for us about this time last year, so thank you for coming back on.
My pleasure.
Excellent. Right. So I think you've got some slides you're going to bring up. We have them. Fantastic. Right. So obviously, as we do every time, we asked for some slides to be pulled together. Mike's going to go through a market commentary just as what their views are from Foresight at the moment. Over to you, Mike.
Great, thank you. It's been a very challenging year for parts of the stock market. It's clearly we've seen some pretty strong growth from areas such as technology, but other more interest rate sensitive parts of the market have struggled. What I'm going to talk about today is the outlook for inflation. We are seeing obviously inflation falling in the UK and elsewhere within the sort of developed world. Give you an overview of the outlook for inflation and how the market is perceiving the likely inflation in the short term and the long term. We'll also talk about interest rates and the direction of rates. Clearly, that has a significant impact on the general economy. And also on asset pricing as well. And as we know, we've been through a kind of a 2-year hiking cycle where rates have gone from close to 0 to just over 5. That's been pretty brutal for assets and the repricing of assets, and also for consumers and those that are carrying debt. And I'll also touch on some growth indications. In both the US and the UK, we are seeing the kind of lagged effect of those interest rate rises that we've seen, beginning to come through in some sort of weaker data in the economy. That clearly is the purpose of raising interest rates, is to dampen down demand, to try and drive inflation out of the system. So just have a quick look at UK inflation. Pretty brutal time when inflation was running at at its peak just over 10%. But you've seen this sort of downward trend in inflation. Yeah, and that is partly the reopening of supply chains around the world post COVID. It is driven by a fall in energy prices. Obviously we saw the big spike up from February 2021 from Russia's invasion of Ukraine, and the latest CPI print came out at 4.6%. So the Chancellor has stated that he's aiming to halve inflation. Obviously the efforts of the central bank in raising rates do some of that, but we are seeing this general trend down to 4.6. We are, however, still a long way off of the 2% inflation rate target. We'll touch on the potential outlook for inflation going forward a little bit later on in these slides. Similar story in the US. Inflation didn't reach such a high level. The US is in essence energy independent, so it's not so tied into to global energy prices. They are a significant producer themselves. But we've seen again the similar sort of trend in inflation falling, the supply chains open. They did have a little bit of a bounce back up in the US in the summer. There's a few quirks in some of the way that inflation is calculated, but the market has taken it pretty positively. The inflation, the latest print in the US, came out at 3.2%. So broadly, we are seeing falls in the overall level of inflationary growth. Clearly, prices are still going up, as we all know when we go shopping. But the rate of increase is falling significantly. So what does that mean for us and for in particular interest rates? Obviously, central banks have pretty much one club they can use in their golf bag, and that was to jack up rates. And we saw interest rates going from say near 0 to over 5. What's the outlook for interest rates? Well, forgive me these slightly complicated charts, but what we're looking at on the left-hand side is the US federal funds rate, in essence the US base rate, and on the right-hand side is the UK base rate. Concentrate on the blue line. That's the implied rate that that capital markets are assuming that rates will be going forward. These are priced by overnight interest rate swaps. The key point here is that we do not foresee any more, the market doesn't foresee any more interest rate rises coming through. Pretty much the view is that central banks are done, that with this falling inflation and relatively weakening growth, or certainly growth signals weakening, then economies cannot stand any higher interest rates, and the battle of inflation, whilst not over, they've done enough policy action that they don't need to raise rates any higher. What we are seeing is, you can see that blue line sort of begins to fall from Q1, Q2 next year. The market is pricing in that interest rates begin to get cut in the first half of next year. Worth pointing out the size of the cuts being implied by the markets, not massive. On the left-hand side, we can see rates falling from, let's call it around about 5.3, 5.4 in the US, down to around about 4.6. So 3 cuts being kind of priced in US policy rate next year. On the UK, on the right-hand side, we're forecasting, or the market is pricing in a couple of cuts, 2 cuts in UK base rates by sort of summer, the end of summer next year. So it looks like this kind of tightening cycle is over. We're not pricing our, well, we're not valuing our companies, and we're not assuming that these cuts actually do come through. But what we do think, and it's really important for investors, is that rates aren't going to be sort of hiked any further from here.
So, Mike, is this suggesting that the US is probably 3-4 months ahead of the UK in bringing down interest rates from what you see here on these graphs?
Yeah, the indication is that the US is likely to cut first. The UK actually did raise rates first, so the Fed was a little bit behind. But it is likely that the action that the Fed has taken, plus say those structural differences between the economies, principally the energy prices within the US, and also food prices in the US, a little bit more domestically focused, mean that they might be able to cut a little bit quicker. But broadly, you'd expect them to largely move in lockstep. It'd be very unusual for UK rates to be going up and US rates to be going down, for example. But yeah, so there might be a small timing difference by the occasional month, but broadly they're going to move in lockstep. So interest rates, at the policy rate, i.e. the rate set by central banks, seem to be anchored. I've just put these charts up to just show market rates. So these are looking at 10-year US Treasury yield. So this is how much it costs the US government to borrow money for 10 years. Just to make this chart a little bit more confusing, I put 2 charts in. On the left-hand side is just the performance of these, or the change in these bond yields over the last 5 years. And the point I'm making here is that from a real low point during COVID, where US 10-year bond yields were trading at around about 0.5%, they spiked up back in October of this year at just over 5%. So we've seen like a 9-fold increase in US market interest rates. So any business or any asset that has a sensitivity to the change in interest rates has clearly had a really difficult time as these rates have increased, particularly within fixed income portfolios. They've obviously fallen in value as interest rates go up. Fixed income securities generally do fall in price. So it's been a really tough time for fixed income investors. Likewise for property and also infrastructure, where my business invests. It's been a pretty difficult environment. However, things don't last forever, and what we are thankfully beginning to see as inflation has fallen and as base rates become anchored, we've just seen over the last sort of month or so that these longer term interest rates, these 10-year bond yields, have fallen from just over 5% to 4.4%. And this might seem quite arcane and a minor fact for investors, but actually this is actually pretty significant. These are pretty big moves in bond markets. the US Treasury market is supposed to be the deepest, most liquid pool of capital in the world. So seeing these kind of outsized moves, and frankly, we've been seeing them for quite a long time now, is typically pretty unusual. So this is positive for us. This is positive for any business that that depends upon raising significant capital to invest for growth.
So does this suggest then that, I guess what I'm trying to say is, does this tie in with the slide before, where they're thinking that interest rates will start to come down in the early part of next year? This sort of US 10-year Treasury bond note, is that a good indicator as to what's, I guess, like a litmus test, a barometer, whatever you might want to call it, of what we think is going to happen?
Yes, indeed. And what you have to consider is that the policy rate is just basically what the central bank will lend to a commercial bank overnight. These rates are how much it costs the US government to borrow. The US government does have to borrow an enormous sum of money. They have a $2 trillion deficit next year forecast, plus having to refinance other debt that is maturing. But these falling rates do give more confidence in the economy and the economic outlook. Certainly for businesses that are looking to raise money to grow. But yeah, broadly, what you're right in that, policy rates and treasury yields coming down is positive for asset markets.
So what it shows you is it's actually become significantly more expensive for governments, not just the US, but obviously this will be replicated here in the UK, to borrow money
Yes.
during this time. And so really, they don't want to see this happening in the market. They want to be able to see the cost of borrowing to come down. And I guess particularly in the US, where they've had their debt ceilings and they've been having problems around refinancing it, this is welcome news as well, I guess, within their economy.
Absolutely, yeah. If when you're borrowing the amount of money, and I think the US stock of debt is around about $33 trillion, and you're adding $2 trillion a year to that, the US government does not want yields spiking up, because as they have to finance more debt, then obviously their interest rate costs go up. And if they carry on at the current rate of deficit spending, the interest cost alone on their stock of debt will equate to 5% of GDP. So not 5% of tax revenues, but 5% of GDP. So this leaves the government with a couple of choices. You can either cut spending, or you have to simply go for greater levels of growth, or indeed somewhere in between. But the sort of status quo ante, I think, is unrealistic. They will have to take some action either on the growth or the spending side to change this dynamic. The market understands this, but it's definitely worth investors paying attention to it. So bond yields, after a kind of a three-year sort of rise, have begun to roll over. That's really positive. But let's just have a quick look at what the market is expecting for inflation. On the left-hand side, we have a chart of economists' forecasts. So these are just people's opinions, or economist opinions, of where where inflation rates are going to settle. And you can see, economists generally expecting rates to continue to fall down towards the 2% target sort of area. The Eurozone, the UK and US all have a 2% target. So the forecast is that rates are going to fall around about that level. Interestingly, no one's forecasting that they are, or none of these aggregates are forecasting that they are going to get to the 2% level. So expecting inflation to be a little bit higher than the 2% target. That kind of makes sense. It's pretty hard to drive that last piece of inflation out of the system. You can drive down goods inflation quite effectively by sort of destroying demand, but actually wage inflation tends to be more sticky, particularly where you have public sector who has bargaining power, as we've seen with many of our sort of public sectors. They have the ability to sort of collective bargaining to drive wages up, as is their right and interest. But it's kind of then you're embedding inflation into the system. So that last little bit of inflation is hard to drive out. On the right-hand side is a slightly different measure. This is looking at how the market is pricing inflation over the period from 2028 to 2033. So these are a technique called 5-year inflation swaps. But basically, it's saying what the market is expecting inflation from 2028 to 2033 will be on an annualized basis. And the blue line at the top is the UK. And you can see that the market is pricing UK inflation to be significantly above the 2% target.
So, Mike, just on that, what you're saying there is it's from, say, 2023, move forward 5 years, and we start then what the markets believe the next 5 years of inflation will be.
Correct. Yes, that's exactly it. So from 28 to 33. And you can see the Eurozone and the US expecting inflation to be above the 2% target, but around about 2.5%. The UK, which actually is historically always has been a higher inflation economy, expecting inflation to be sort of 3 to 3.5% at that point. So I think the takeaway for investors there is that if we are at the peak of interest rates, but inflation is falling, but likely to remain sticky at let's say that sort of 3.5% level, then cash, which is an obvious place to go to when things look kind of wobbly in markets and in the economy, cash may not be the best place to make real returns if inflation is at these kind of 3.5% levels. So definitely worth sort of keeping an eye on inflation expectations as well as the actual inflation rate.
Can we just explore a little bit more about why there's the differences between the UK economy and the others here? So you can see obviously Eurozone looks like their inflation is going to be up a little bit higher, but the US has been relatively constant, but we've always been relatively constantly higher on our inflation rates. And one thing you mentioned earlier was sort of the bargaining power of some public sector areas in terms of increases in salaries. And obviously, I think we've seen quite significant increases in the private sector over the last 2 to 3 years. Is there any sense at all out there at the moment that might be the pressures might be coming off in those areas, or do you continue to think there will be this above inflation in some places pay rises, or is there any sense as to what the markets are predicting there?
Yeah, so the key metric to look at there is really unemployment. So unemployment still remains relatively low. We have and this isn't just the UK, but around the world, we have a bit of a phenomena of a disappearing workforce. So the actual number of people working in economies, as a proportion of the overall kind of working age population, has fallen. I think we've lost about 500,000 people who have not returned to the workforce post COVID, and lots of debate and discussion as to what's happened to those people. But I think the key driver for wage inflation is unemployment at the moment, and over the last sort of year or so. Certainly, the labor, as in the labor force, has had collective bargaining power because there's lots of job creations and not enough workers. If we see a pickup in unemployment, maybe that dynamic changes, and that the balance tips more in the employer's favor than the employee.
So just a bit on that, I'm just looking at the Office of National Statistics at the moment, and it is suggesting that there is a slight tick up in terms of unemployment rate, going from sort of 2022 June last year, 3.5% up to where we sit today, 4.3. So there's certainly a tick up. However, it's from a historic low of unemployment. When we look back, I think the last time I can see was 1973, 3.5% on this chart. So it can show you that we've predominantly been in the 5 to 7% area of unemployment. So actually, we are still at historic low, and that's obviously echoes what you've just said, that there's a big group of people that have not necessarily re-entered the workforce after COVID. So I guess the question I have is, are there any indicators out there that the slowdown in the economy is potentially going to lead to some job losses? I know we've heard of a couple of companies, unfortunately making job losses, but do you think we're going to see more in the next 3 to 6 months? Or is it this sort of soft landing that we've spoken about mean that we'll probably scrape through without many job losses, and therefore that's why inflation will remain where it is?
Yeah, it's a really hard one because obviously it is kind of company by company and industry by industry. I think what we have seen is that companies have been very keen to hang on to their workforce. Post-COVID, it's been hard for companies to source staff. So typically what they have done is hung on to their workforce through to a slowdown because they don't want to get into a position. Let's say if we have a slowdown in the economy or a recession in the first half of next year, businesses don't want to then get to the back half of next year and then have to spend another 6 months to try and sort of rehire a workforce that they kind of laid off for 6 months. So if that does repeat, generally what that means is that will put some pressure on corporate profits because in essence they will be hoarding labor that they don't need. However, as a shareholder and as a business owner, you may think, well, I don't want to be carrying these kind of higher costs. So it's kind of hard to give a kind of precise answer. But what one would assume, if you settled on, well, you'd see a bit of a pickup in unemployment. You see a bit of a fall in sort of corporate margins, profit margins, but you wouldn't see a particularly deep rise in unemployment, which clearly no one wants. That would be a reasonable outcome to sort of surmise from here.
Right, thank you.
But as an investor, I think it's definitely worth kind of watching the unemployment rate as well as the inflation rate as well. Just Mike and I did speak about stock markets when we were at the beginning of this call and what's been performing and where areas of strength have been. What we're looking at here is the S&P 500. So these are the biggest 500 companies in the US stock market. I quite like the way that this sort of schematic works. The bigger the box is the bigger the size of the company by market capitalization, and broadly, the lighter the green, the stronger the performance of their stock over 1 year. The darker the red, or sorry, the lighter the red is the weaker their stock performance. And what we've seen year to date, many of you have probably heard of the Magnificent Seven. There's been sort of 7 technology type companies that have really driven the majority of the returns in the US stock market. Certainly up until a month or so ago, they pretty much contributed all of the returns of the S&P 500 just came from 500 companies. So you can see the likes here of Microsoft, Apple, Google, Amazon, Tesla that you're all probably very familiar with. So the market had been pretty concentrated into areas, largely this was being driven by the sort of the growth of AI or the expectation of growth being driven by AI, and that these companies would be in a strong position to exploit that. Frankly, I think the market was looking at areas because the economy was not under pressure. The economy in the US has been pretty strong, but with interest rates rising, people are trying to find out, well, who are going to be the long-term winners if we see some sort of contraction in the economy going forward. And obviously, that area that people are focused on was very much those Magnificent Seven stroke sort of technology stroke AI type businesses. If we just look forward for 1 month, so this is just the same chart, but with 1 month performance. Clearly, if you've invested in Microsoft over the last month, you've had fantastic returns. They've reached their all-time stock price high. But the point I would sort of draw on is that it's been areas, elsewhere on the right-hand side and the lower part of this chart have actually begun to perform well. We're not making any predictions about what's going to perform well going forward. But what you can see is as inflation has cooled and as expectations of interest rate rises have sort of dissipated, and people begin to think, well, maybe we're at the top of that cycle for interest rates and potentially they're going to be cut. It's been other areas of the market that have also been growing, and that's pretty healthy for the stock market. You really don't want to be investing in a stock market that is concentrated on a handful of names, obviously for simplistic sort of risk reasons as well, but it's generally not a particularly healthy sort of indicator of a stock market if it's concentrated in less than 10 names. So this broadening over the last month actually is generally a pretty positive sign.
Just quickly on that, Mike. Obviously, this last 1 month does play into the year-to-date figures. So actually, even if we went back another month, you might have seen more of a concentration just on those Magnificent Seven, because I've been talking to people where they say you strip out the Magnificent Seven, and actually over the last 12 months the S&P 500 has been pretty flat. There's been hardly anything happening there at all. So
absolutely, and frankly, the majority of the S&P 493 were broadly still in a bear market. They hadn't
Right.
actually recovered from 2022. So you're right. Yeah.
And this, for me, if you look at the type of industries that are now starting to look more positive, some of them might be a bit more capital intensive. So that, you know, the fact that you're talking about borrowing costs coming down overall, and that's starting to look a bit more favourable. It's what we've been really after, isn't it? Interest rates to come down, borrowing costs to come back down, to signal then that businesses can start to consider their growth plans over the next 2, 3, 4 years.
Yes, absolutely. And what's also interesting here is if you look at the energy sort of complex on the right hand side, you know, oil prices have fallen. Yeah, you can read that two ways. One that's positive for growth, or two, it's negative because demand has weakened. I won't make a comment on that, but that's actually interesting. You know, falling energy prices generally a positive for, you know, future economic growth, as it's a lower input cost for everybody, and that should also then, you know, continue that sort of drive down in inflation.
Brilliant.
But there are no free lunches. So I without wanting to sound sort of bearish, because, you know, we are pretty positive on stock markets, particularly the UK stock market actually. But I just wanted to show some data on just a lead indicator of the UK, which is, you know, UK retail sales. And we're just looking at the monthly prints over the last year. And, you know, the latest print again was negative. The UK consumer is clearly under pressure. We're having to wrestle with higher interest rate costs. We're having to wrestle with, you know, highest levels of taxation for 70 years. All the, you know, the input cost from the inflation that we've been suffering is basically taking money out of the consumer's pocket. And as, yeah, you're seeing this deterioration in the consumer. So the Bank of England was forecasting, you know, a 50% chance of recession next year, broadly forecasting flat growth in the UK economy for 24 and not much growth in 25. You know, we are stuck in a pretty low growth, stagnant economy, but with, you know, this persistent level of high inflation. So it's kind of tough times for the UK. That doesn't mean to say that necessarily the UK stock market is a bad place to invest, because the stock market is actually very cheap in the UK. But I just think from a macro sort of perspective, it's a pretty difficult environment for all participants in the UK.
So, Mike, I was going to say, does that mean that on the basis of what you've just said, that the Chancellor's going to pull some rabbits out of the hat in his awesome statement to try and get the economy going?
I don't think he has any rabbits to pull, and I'm not entirely sure he has a hat either. So I think it's pretty tough. And, you know, we have record levels of tax at the moment. We have, you know, obviously, you know, high inflation. He doesn't want to stimulate too much because he doesn't want to create more inflation. You know, we are about 100% GDP in terms of government borrowing. So the policy options for, you know, be it a Conservative government, or if Labour win the next election, a Labour government, their policy options are really constrained. What we would say is, you know, what we need to do is drive productivity growth. You know, productivity growth in the UK has been, frankly, kind of woeful for thick end of 20 years, and that's the area of the economy that we or the thing that we need to address. These things are not insurmountable, but, you know, we've got limited levers to pull.
Sorry to put you on the spot, Mike. Productivity. When they talk about this mysterious productivity figure, where do they get this data from? What is it including? Have you got any ideas?
Well, in simplistic terms, you could say it's GDP divided by the number of people working in the or people working in the workforce divided by GDP.
Right.
So in simplistic terms, I wouldn't know the precise sort of calculus that they use to derive the number.
I just wonder whether it's a very crude calculation, or, you know, because there's always different people in different industries who think, well, I'm working really hard. So what is it they're referring to?
Yeah.
Is it, you know, what you're getting out of your people in terms of their productivity? You know, how many widgets they're making, that sort of stuff, or is it, like you say, just literally a very crude calculation?
Yeah, what one assumes it's productivity or GDP or share of GDP
per head
per productive worker. Yeah.
Right. Okay.
Yeah.
Thank you very much.
You know, one of the, you know, One of the issues in the UK has is are we investing enough in automation and technology, or do we depend on cheap labor, which is obviously good for business management because they can without having to invest too much, you can tap a pool of cheap labor, but it actually doesn't drive productivity growth. And if your competitors are investing in tech and automation, they steal a long-term march on you. So I think that's something definitely that the market participants kind of do fret about, and economists endlessly debate about why the UK appears to have such weak productivity growth. So the final point I was going to make was just around about where do we go from here? So if you assume that the effect of rising interest rates usually takes somewhere around 18 to 24 months to actually filter through into the real economy. We're at that point now where we are 24 months after, or 23 months after the first interest rate hike in the UK. So we can definitely all feel the effects coming through. Less money in the consumer's pocket. You're seeing a deterioration in sort of consumer confidence and a general sort of malaise in sort of corporate confidence. We potentially will be heading in for a bit of a soft patch or a softer patch in the economy. So what we think is a place to invest is companies that have very high quality earnings. And what we mean by that is very visible earnings that are the repeatable year after year. So they're not dependent upon selling lots of goods and services in year 1 and 2 and not much in year 3. Just stable kind of profits growth and stable income growth from investee companies. And you can see here, this is US data, but broadly what it's showing is that the types of stocks that perform well in a weak or sort of recessionary sort of economic environment, one of the factors that you want to look for those companies is this high quality of earnings. So visible, repeatable earnings from companies with solid balance sheets, so they're not over levered, and good quality management. So the areas that we would look at, maybe some of the consumer staples. We invest in infrastructure, where you have contracted revenue, i.e., you're not selling goods and services. You enter into a contract to run an infrastructure asset or build and maintain an infrastructure asset over multi-decade periods. So we think trying to protect yourself if we are going into an economic downturn, particularly now we've got interest rates sort of peaking out. These types of infrastructure businesses should provide you with some defensive, high quality earnings looking forward.
Brilliant. So, Mike, just a summary then. Does it feel like we are in more chartered territory now in terms of understanding where the markets are likely to go, what's potentially going to happen? I always caveat that with there could be something out of left field that no one's anticipating. Yep. But on the basis of everything you've said, the fact that the last 12 months have been fairly, I guess nothing much has happened in the market terms. All things being equal, we might start to see things improving in 2024 at some point.
Yeah, I think the markets have, barring those sort of technology companies, broad markets have trod sideways for thick end of 2 years now. I think, yes, we're in an environment now where we can take off the table, all other things considered, further rises in interest rates, and that is, that definitely provides some relief for asset markets. As you say, if there is some exogenous shock that hits the economy, then inflation could pick up again and interest rates have to rise again. But with the economy and everything that we can see today, you've taken one of the big risks off of the table, which is rising rates. I think what investors have to consider now is, what is the impact of those rates? Is it that we can engineer a soft landing, i.e., bring inflation down without sort of pushing the economy into recession? That historically has been hard to do, but potentially is something that could well have been engineered, particularly in the US. So I think we're entering into a period of I hate this term, I'm going to say it anyway because I can't think of anything else, but a new normal. settling into an environment of probably lower growth, higher inflation, and persistently higher interest rates than we've seen over the last 15 years or so since the financial crisis. So in that sense, I think as investors, you might have to be more nimble. There's going to be less of a sort of a free swing of the bat in terms of just loading up on risk. But that said, there's lots of areas of the stock market that were pricing, were concerned about much higher interest rates. So there are areas where stocks undoubtedly are very, very cheap. And I think as more data comes through, if inflation continues to fall, those areas of the stock market likely could perform pretty well from here.
Fantastic. That's great. Thank you very much, Mike. Really appreciate your presentation today. Everyone, thanks for joining, and we'll be back in December for another market update. Thanks very much.